Do you want to pick stocks that hold up in a recession and avoid the ones that don't? Stick with me, kid.
Stick with me, kid. I have you eating lunch like that every day.
Hey guys, I'm Jasper, a financial market analyst working with Trading 212 to help improve your financial education. Please note that nothing in this video should be construed as financial advice. The purpose of this particular video isn't to weigh in on the debate over when the next recession will arrive and if it does, how long lasting it will be. I'll leave that to FinTwit, the community of tweeters on the topic of finance on Twitter. Oh, well, yes, that was a cat video, but I do post about markets with FinTwit guys too, I promise. Now, the questions to be answered here are, if a recession is either here or likely in the near future, what can we do as investors today to make sure our portfolios are ready? How should you pick stocks today if you're worried about a recession arriving soon? Which sectors and which types of stocks tend to be more resistant to recessions? First things first, if a recession is expected, then it logically follows that all stock valuations may be vulnerable in the near future. This means that on average, stock prices today might be higher than they will be if a recession lands in the next quarter or two. That means a level of caution is required. This does not mean selling everything and building up your so-called dry powder, ready to go to battle in a future strong economy. It also doesn't mean stop managing your portfolio and putting your head in the sand. This approach could be foolhardy in an environment where some types of companies and some sectors can be expected to hold up better than others on average. As we shall see, observable and analyzable factors such as dividends, market position, and economic sector provide an array of tips that can help investors make their portfolios ready for any outcome, even a severe recession. What type of stock will probably fare better than average if a recession hits? To answer this question, we need to quickly cover the difference between cyclical and defensive stocks. Cyclical stocks are those which tend to follow the rhythms of the business cycle very closely. This means that they will perform very well when GDP is rising and can be expected to falter and go into reverse when economic conditions worsen. As such, their valuation tend to follow and be determined more by the business cycle than other variables. Typical cyclical stocks include car manufacturers and airlines. In general, fewer people will purchase a new car when the economy is in or close to recession, and likewise, consumers will tend to cut things like holidays, which are perceived to be non-essential or luxury purchases, if they have some doubts about the health of the economy moving forward. A subcategory of cyclical stocks is consumer discretionary stocks. Because of the type of consumer spending that generates revenue for these companies is discretionary and non-essential in nature. Now, an investor anticipating recession would be less likely to want to buy consumer discretionary stocks because it seems probable that if a recession arrives, consumer incomes will fall, meaning lower expenditure on these types of items too. This fall in revenue for cyclical companies should lead to the valuation of their shares falling, therefore making them comparatively unattractive if a recession is around the corner. So, cyclical stocks, of which consumer discretionary stocks are just one example, are unlikely to be popular when investors expect a recession. At the other end of the spectrum are so-called defensive stocks. These are stocks that are likely to keep performing acceptably regardless of the overall economic climate. As such, whilst their value may fall a little during a recession, they will hold their value much better than cyclical stocks over the same period. Similarly, defensive stocks would tend to be better at maintaining their dividend payments even through times of economic distress, providing another reason why they are often preferred to cyclical stocks in a recession. A classic example of defensive stocks would be supermarkets and utility companies. Even in the worst recession, the vast majority of the population will continue to do their weekly shop for groceries and other household items, and although they will of course look to save money where they can, these items are essential for daily life, and so avoiding buying them is impossible. Likewise, companies that provide energy or water will be very likely to see their customers keep purchasing their goods and services due to their non-optional nature. So if you want to find recession-resistant stocks, start by looking in defensive sectors and avoid companies whose earnings fluctuate a lot with the business cycle. Next, we can use dividend stocks as evergreen investments. Stocks that have a proven track record of paying out dividends to their shareholders are attractive in any phase of the business cycle. For this reason, they could be thought of as evergreen investments in that they are always useful to have in your portfolio. In the context of recession, dividend stocks start to look even more attractive. As we know, there are two main ways to make money buying stocks. That's firstly when the share prices go up from when you bought them, and then the second one is when you earn a dividend. If you are earning a reasonable dividend from your portfolio shares, then you won't need to be as concerned about the share prices falling in a recession. So dividends can provide a silver lining during an otherwise stinky situation. Of course, if more people are focusing on their dividend earnings during a recession, then naturally there is more demand for those investments, and as a result, the share price tends to fall less compared to companies without dividends or less consistent dividend payouts. I did a series on dividend investing, the first of which is getting started with dividend investing. Make sure to check it out to learn more about this type of investing. Another common question is, should I look to value or growth stocks with recession expectations high? You might already be familiar with the categorization of value versus growth stocks from the Trading 212 video of the same name from Tom Morgan. What might be new, however, is applying this distinction to the question of how to pick recession-resistant stocks. The obvious answer is to plumb for value stocks. Because they're cheap relative to both their book value and the rest of the market, value stocks should logically have less far to fall in price than their growth rivals. Likewise, when the economy recovers, value stocks should be better placed to return to growth given their lower PE ratios and the fact they're probably closer to profitability than growth stocks. The core ideas needed for picking recession-resistant stocks are pretty much done at this stage. But let's deviate off topic a bit here. If there's a recession, are there some stocks we might want to own even if we don't expect them to resist the recession very well? You know there is. If an investor is thinking longer term, a recession can be the best time to move into growth stocks if and only if you want to try to pick winners and are happy to take the risk and accept the idea that you might be sitting on a losing investment for a while. Let's use one of the best known historical examples. The dot-com bubble of the early 2000s saw the early enthusiasm for the internet lead to a flood of investment into online companies. As always, the bubble inflated for several years before dramatically popping when the market sobered up and realized not every company with net in its name would go on to conquer the world and generate massive profits. Over 90% of early online companies, some of whom had their stock prices soar over the previous years, went bankrupt following the bursting of the dot-com bubble. However, as we all know today, several of these generation of growth stocks did go on to conquer the world and are today some of the largest companies in the world. Amazon, Google, eBay, Microsoft, and others were all classed as risky growth stocks in the early 2000s, and anyone who bought into those stocks before the crash and held them until today, despite several recessions, have done exceptionally well. Although, as we know, past performance is no guarantee of future results. I didn't mention this idea of growth stocks just to completely confuse the idea of recession-resistant stocks. Not at all. It's just to remind you that you can be employing different strategies with different time horizons at the same time. It's okay to find recession-resistant value stocks in defensive sectors paying dividends to shore up your portfolio, while at the same time trying to find the next big thing that may never return to such low prices and multiples again. Okay, if you don't mind, I'm going to try and summarize some of the main points I've tried to make here. A recession means stock prices on average will fall, but this won't affect all sectors and all stocks equally. Look for stocks that you like in so-called defensive sectors where prices are likely to fall less than the market average. Recession-resistant stocks are often also those with records of paying steady and ideally increasing dividends over time. Value stocks will probably hold their value better than growth stocks in the short term if the economy goes into recession. But looking further out, growth stocks may well rebound fast as the recession starts to fade. Recessions can be fantastic times to hunt for bargains, and if you can, buy the dip. Alright, I've spun my yarn about recession-resistant stocks, but what about you out there? What are your tips for picking stocks in a recession? We love it when you share, so please drop us a comment. And if you like this video, please make sure to smash the like button, subscribe and hit the bell icon so you see these videos as soon as they're released. Thank you very much for watching and happy investing.